Greetings, everyone. My name is Tyler Miller, and I'm a CPA, Certified Financial Planner, and Wealth Manager here with Raymond Gorell Wealth Management. Today, we'll be covering one of my favorite tax strategies within the Apple 401k plan, the Mega Backdoor Roth. This strategy gives employees a way to turbocharge tax advantage savings beyond normal IRS limits in their 401k plan. If you or someone you know could benefit from this strategy or the other services our firm offers, feel free to contact our team for a complimentary consultation, where we will review your financial situation to determine opportunities for optimization from an investment, tax, estate planning, employer benefits, and retirement strategy perspective. So, without further ado, let's jump into today's topic, the Mega Backdoor Roth. So what is the Mega Roth? At its core, the Mega Roth is a tax strategy embedded within the Apple 401k plan. By undertaking a series of transactions, employees can make contributions beyond normal IRS limits to the plan. For instance, in 2026, employees can contribute $24,500 either via pre-tax or Roth contributions, with a catch-up contribution of $8,000 if you'll be over the age of 50 by the end of the year. The Mega Roth allows certain employees to add tens of thousands of dollars beyond this to the plan annually. I'd like to take a moment to refresh everyone's memory on how pre-tax versus Roth contributions work for tax purposes. As I previously mentioned, for 2026, employees can contribute $24,500 to the pre-tax or the Roth account, or some combination of the two. Pre-tax contributions, as we may know, involve making contributions before federal income taxes are paid. However, all your contributions, as well as your growth on those contributions, will be taxed as ordinary income upon distribution. Roth contributions, on the other hand, are made after federal income taxes are paid, and therefore all of your future growth, as well as your original contributions, are tax-free when they're distributed to you. The determination of whether an employee would want to make pre-tax versus Roth contributions is entirely dependent upon their current tax rate versus their future tax rate. Concurrently, with your pre-tax or Roth contributions, the company will be making a 6% matching contribution to the pre-tax account if you have 6 or more years of service with the company. Based on the contributions discussed above, the total going into the 401k plan for an individual maximizing the pre-tax contribution and making $300,000 a year is $42,500 from a combination of the employee's contributions as well as Apple's. This $42,500 total is well below the IRS maximum contribution limitation for all sources of contributions, which is $72,000 for those under the age of 50 and $80,000 for those over the age of 50. So, where can this $29,500 difference between the IRS limit and the other maximum contributions go? You guessed it, the after-tax account. So let's discuss the tax features of the after-tax account, because they're a bit of a blend of the tax features of the pre-tax and the Roth accounts. After-tax contributions, as the name implies, are made after federal income taxes have been paid from the funds. However, the growth that occurs while inside the after-tax account will be taxed as ordinary income upon distribution. So you might ask yourself, why would I contribute to an account with no current tax bill reduction, but all my growth will eventually be taxed as ordinary income? This is because we don't intend to leave the funds in the after-tax account to grow indefinitely. The Apple 401k plan allows participants to convert these funds from the after-tax account to Roth. And the best part, if funds are converted to Roth before growth occurs, this conversion is entirely tax-free. Here's how it works. Once the normal pre-tax or Roth limit for contributions is reached, the employee may defer additional funds into a third repository within the plan, the after-tax account. Subsequently, these additional funds are converted into the Roth account, where you will enjoy tax-free growth until these funds are distributed in your retirement years. At this point, we hope it's becoming clear that this strategy can be an absolute tax home run for retirement savers. It's also important to note that most 401k participants outside the Apple plan cannot use this strategy. While some large companies do have this capability, if you take a look at all 401k plans in the US, only about 3 in 10 offer the Mega Roth. Before we wrap up our conversation today, I'd like to draw your attention to a few important considerations surrounding the Mega Backdoor Roth. To better illustrate the tax benefits of this strategy, we'll compare an individual who fully utilizes the Mega Backdoor Roth strategy over their career versus diverting the same after-tax funds into a taxable brokerage account. Using the same numbers from the previous example, let's say this employee contributes $29,500 per year for 20 years to a brokerage account. Assuming an 8% growth rate, these contributions will grow to $1.35 million over the 20-year period. This means that within the taxable brokerage account, there will have been $590,000 of contributions and roughly $760,000 of growth. Assuming a 15% long-term capital gains rate, this will result in over $100,000 of taxes paid when the assets are sold. If instead, this employee utilized the Mega Roth strategy over the same 20-year timeframe, all of the dollars could be distributed in a tax-free manner, resulting in over $100,000 of tax savings. If you have a pre-existing after-tax balance within the Apple 401k plan or growth on recent contributions, you should be aware of the pro rata rule. The pro rata rule states that if an after-tax account contains a mix of contributions and taxable earnings on those contributions, any conversion or distribution from that account will be partially taxable, depending on the ratio of contributions and earnings. These numbers are different for everyone, so we absolutely recommend that you discuss the effect of any current balance that you have within the after-tax account with a tax expert who can help you understand the implications of any future conversions. Thanks again for spending some time with us today to learn about the Mega Roth strategy. At Raymond Gorell Wealth Management, we have over $1 billion in assets under management. As a firm, we strive to serve as an effective one-stop shop for comprehensive retirement planning. Our team of CFP and CPA professionals specializes in helping clients take advantage of advanced financial strategies to materially enhance their ability to enjoy life both before and after retirement. We invite you to schedule a complimentary consultation with our team by giving us a call, sending us an email, or visiting our website today.